Hey friends, Iggy here from the Investing Iguana, and welcome back to Module 3 or Video 4 of the 100K Dividend Foundation. In Module 1, we learned my safety check for dividend stocks. In Module 2, we decoded the 3 key metrics for S-REITs. If you missed those, the links are below. Now let me ask you something. Do you ever worry that a wild market swing could undo years of careful saving? If you do, you're definitely not alone. The truth is, if your entire portfolio relies just on stocks or REITs, you might be taking on more risk than you realize. That's why today, we're unpacking what I call the stability pillar. Think of it as your portfolio's safety net, the part that helps you build wealth and still sleep well at night, even when the markets get choppy. We'll cover Singapore's best options for stable, stress-free investing, specifically Singapore savings bonds, SSBs, T-bills, and retail bonds, ETFs. We'll look at how they work, the risks involved, and how they might fit with your CPF or SRS accounts. So let's dive in. Safety might not sound exciting in investing, but trust me, it's the bedrock of a solid portfolio. We have 3 main tools in our stability toolkit here in Singapore. First, SSBs. Think of these as your ultra-safe, flexible foundation. Second, T-bills. Still very safe, but offering potentially higher yields if you can lock up your cash short-term. And third, retail bonds or bond ETFs, stepping slightly up the risk ladder for potentially better returns. So let's break them down one by one. SSBs are probably the simplest and safest investment product available to us. They are fully backed by the Singapore government, meaning the risk of losing your capital is virtually zero. Here's how they work. The interest rates actually step up each year you hold them, rewarding you for staying invested. But the killer feature is flexibility. You can get your money back in any given month, with no penalty and no capital loss. This makes SSBs the absolute core for any stability pillar, especially for your emergency fund or money you'll need in the next few years for big goals like education or a home deposit. It's safe, it grows, and it's accessible. Next up, Treasury Bills, or T-bills. These also come from the Singapore government, so they're extremely safe, but they work a bit differently. T-bills are short-term, usually 6 or 12 months. You buy them at a slight discount, say $990 for a $1,000 bill, and get the full $1,000 back when it matures. That difference is your interest. The yields on T-bills are variable, depending on the auction results, but they are typically higher than fixed deposits or even SSBs for the same short period, often ranging from 3% to 4% depending on market conditions. But here's the catch though, there is no early redemption. Once you buy a 6-month T-bill, your money is locked in for those 6 months. So T-bills are fantastic if you have spare cash you won't need for 6 or 12 months and want to earn a better return safely. And yes, you can use your CPF OA funds for T-bills. Just make sure the T-bill yield is higher than the OA interest rate you're already getting. What if you want a bit more yield and you're okay with taking on a little more risk? That's where retail bonds like the Astria series or Bond ETFs come in. These are usually issued by companies or quasi-government entities. Because they aren't directly backed by the government, there is credit risk, a small chance the issuer could fail to pay you back. But because of that risk, the yields are usually higher, often in the 4% plus range. Astria bonds backed by private equity assets have a solid track record for their Class A notes. Bond ETFs, which you can buy and sell on the SGX, bundle hundreds of bonds together, diversifying that risk for you. Consider these only if you understand credit risk and want something that sits between ultra-safe government bonds and the volatility of stocks. Remember, these can potentially lose value if the issuer runs into trouble. Okay? We have our 3 tools, SSBs for flexibility, T-bills for short-term locked-in yield, and bonds, ETFs for potentially higher yield with some risk. The big question is, how much should you put where within this stability pillar? Remember, we'll talk about the overall split between stability and growth in Module 4. There's no magic formula, but here are the key questions to ask yourself. Number 1, when do I need this money? Your time horizon into liquidity needs. If it's your emergency fund, you need the instant access of SSBs. If it's cash you won't touch for a year, maybe T-bills fit. Number 2, what's my priority? Yield or flexibility? Your yield requirement. Maximizing yield on safe cash might point to T-bills, while balancing yield and access points to SSBs. Willing to take measured risk for more yield? Maybe bond ETFs. Number 3, How much risk am I really comfortable with, even for safe money? Your risk tolerance. Lowest risk means sticking purely to government SSBs and T-bills. Here's a quick example. Someone building a $30,000 stability pillar might put $15K in SSBs for emergencies, $10K in T-bills for spare cash, and $5K in a bond ETF for a long-term yield boost. Your mix depends on your answers. Be intentional about why you choose each one. We'll see how this pillar fits into the full 100K picture in Module 4. Now, even safe assets have nuances. Keep these risks in mind. First, interest rate changes. If rates rise significantly after you buy a bond, newly issued bonds will pay more. This can make your older bond less attractive if you need to sell it before maturity. Second, credit risk. Remember, retail and corporate bonds are not government guaranteed. There's always a small risk the issuer could face financial trouble. Third, liquidity needs. SSBs are your flexibility champion. T-bills and some individual bonds lock your money up. Match the product to when you actually need the cash. Can you use your CPF or SRS funds for these? This is a common question for Singaporeans. Here's the quick rundown. For T-bills, yes, you can use your CPF ordinary account, OA. But only do it if the T-bill yield is clearly higher than the CPF OA interest rate, currently 2.5%. Always do the math. For SSBs, you cannot use CPF funds, but you can use your SRS funds. For bond ETFs, some are approved for SRS investing. You'll need to check the specific ETF. The golden rule here, always double check if the potential yield you're getting is truly worth giving up the guaranteed returns or specific rules associated with your CPF or SRS accounts. All right, let's wrap Module 3 with your key action steps for building this crucial stability pillar. 1. Build your sleep well. Core. Prioritize SSBs for flexibility and capital safety, especially for your emergency fund. 2. Boost returns safely. Consider T-bills for cash you know you won't need for 6-12 months. Look at bond ETFs or quality retail bonds only if you understand and accept the added risk for potentially higher returns. 3. Understand every product. Don't just buy something because you heard about it. Read the fact sheet, know the terms, understand the risks. 4. Align with CPF/SRS rules. Only use these retirement funds if it makes clear financial sense compared to the base interest rates. And that's your stability pillar explained. You now understand the key safe assets available to Singaporean investors and how they fit different needs. We've covered stocks in Module 1, REITs in Module 2, and now stability in Module 3. So what's next? How do we take these 3 distinct pillars and combine them into one balanced, effective portfolio? The 100K Foundation framework itself? That's exactly what we cover in Module 4. The 100K framework, putting it all together. This is where the strategy really comes to life. Click the link on the screen or in the description below to start Module 4 right now. Don't miss this crucial next step. I'll see you there.